And we have a new trading day underway, folks. So we saw stocks are rallying into this market this morning. The Dow futures were up better than 1%, and we are extending that rally here in regular trading. Let's welcome in Michael Lee now of Michael Lee Strategy, along with Brian Sozzi and Jared Blickery. So, Michael, we've got the Dow up 200 points here, seconds into the trading day. It seems like all roads are pointing up lately, right? I mean, we've got the S&P 500 up about 38% since the March lows. In your career, have you ever seen such a big disconnect between what's happening on Wall Street and what's happening on Main Street? And not just that, but also when you look at the fundamentals of this market, data that is weak that would normally push this market off a cliff is really doing just the opposite.
Yeah. So, Alexis, no, I've never seen data this disconnected from what's going on in markets, but we are at extraordinary times. I think the explanation for this has to go to a new word that's been floating around, the Treasury, which is a combination of the Fed and the Treasury, similar to Bennifer or some of these other, funny acronyms that we've had out there. But the action they've taken is really dramatic. And if you take a step back and you think about it, you've essentially eliminated bankruptcy risk, insolvency risk for the bulk of the S&P 500. So if you're going to invest, what's the risk of investing in a stock? The risk of investing in a stock is that it goes bankrupt. Okay. How does it go bankrupt? It runs out of money. And if you are not going to have any liquidity issues because of the programs the Fed has put in place, that would mean that there's a lot less risk in the overall markets, leading to a higher valuation. What it also does is assure somewhat of a V-shaped recovery. Okay, because many of the largest companies are going to stay solvent, stay in business, be able to continue operations, continue paying people. Okay, when you add that to the fiscal stimulus, which by all means, it looks like it's working really well. You had personal incomes jump 10% last month, which was the highest ever. You have the savings rate at 30%. So it looks like this demand is really going to be there on the other side. Well, so the demand shock, I think, has been remedied to a certain degree, and the supply shock. So I'd say the good part about these riots, these protests, this looting, is that we can give up this social distancing unless there's a massive breakout in the next 2 weeks, which I don't see happening. So you're starting to see things being solved from both the demand side, the supply side, and also all these lending facilities that the Federal Reserve and the Treasury have set up to assure that companies stay in business. Means that we're not only going to have the steepest recession, we're also going to have the quickest recovery. And I think the recovery may end up being just as violent to the upside as the recession was to the downside.
Michael, I think you just called the market top by dubbing this the Treasury rally. But I'm just saying, I've been around this business a while. Like that's what happens. But I don't want. Listen, the market rally, it is what it is. But what is the one data point? What is the one thing you would see that would take down this market? COVID-19 hasn't taken down this market. Protests haven't taken down this market. Various new tweets from the president hasn't taken down this market. What would take down the market?
So what I see is evaluation. Do we get another 10 or 15% run from here? And then on the other side, you see profit taking and then shorts coming in, and then everybody ensuing into a panic. So I see valuation as kind of the only catalyst right here. If you look at the bottom of a recession, it's typically between when initial claims and continuing claims both peak. And it seemed, or continuing claims start to decline. So if initial claims peaked at the end of March and continuing claims peaked in the middle of April, that means the bottom of the recession was somewhere in between there, and we are now entered the recovery phase. So I can see this economy and the unemployment rate snapping from a 20% to a high single-digit percentage point very quickly. And when you add to that the liquidity that's out there in the form of the Fed stimulus, so you've put $6 trillion into an economy, and the Federal Reserve Chairman saying, hey, we've basically got an unlimited amount of money to fight this. Now, that can't work forever, and there are many long-term problems associated with that. But in the short term, financial markets have recovered. And with those financial markets recovering, you also have the aspect of the wealth effect. So if people's 401ks are at 95% or 85% of where they were at all-time highs, people can have confidence to go out and spend, especially if they see their job picking up, they see the economy opening up. It leads to this coming back, and knowing that you have that Fed backstop, that a lot of these major companies have no risk of running out of liquidity, running out of capital. It means you're going to have much higher valuations of these companies because you've eliminated default risk for most of them. So look, this reminds me of June 2009, where the market had rallied 30 to 40% off its lows. And you're looking at the economic data, it looks terrible. Remember, unemployment didn't peak then until March of 2010. So things were getting worse. You had a much less business-friendly administration than you do right now. And there was a lot of angst against corporate America at that point, which I don't think you see right now. So I think you have the runway for much higher stock prices over the next few years. And a lot of people that were bearish in 2009 were bearish up until a couple of months ago, and they missed this entire rally. So I'd say to people, you need to be invested, you need to stay invested.
All right, guys, I want to bring to your attention Stanley Black & Decker up 3.5% right now. Looks like a lot of people are going out there and buying some power tools, maybe doing some projects around the house, because Stanley Black & Decker also are raising its revenue guidance for the quarter. Let's check in with Jared Blickery now for a closer look at commodities. Namely, Jared, I'm looking at the dollar here and oil, which is a little bit higher today.
Yeah, crude oil just keeps pressing higher, defying expectations. And we did have some negative, potentially bearish news overnight. And that's when we saw this dip just a little bit ago, but climbing into the green right now. That news is that OPEC Plus, there were rumors that they were going to meet early this week, but maybe that's not going to happen anymore. Maybe there's not going to be a June meeting, in which case the production cuts would roll off next month in July. The reason being, Iraq and Nigeria have been cheating on their quotas, and unless they get back in line, this could derail the oil rally. But having said that, on the flip side, the demand side, as we were talking about over the last few days, China, some of the numbers have been picking up there. I think their services PMI rose for the first time in 4 months. So that is a bullish headwind for crude. Now, also taking a look at the U.S. dollar, which you mentioned, this is now down the fifth day in a row. This would be the U.S. dollar index, heavily weighted toward the euro, and we can see it just trending down over the last 5 days. Now, on a year-to-date basis, still largely going sideways, but just kind of breaking down right now. Now, the dollar is kind of famous for giving a lot of head fakes. We had one in March where it broke to the upside and subsequently reversed. So we'll have to see where this goes. But a weaker dollar is good for emerging markets, and it's good for the risk-on environment in which we are right now.
All right. Thanks, Jared. Also, this just crossing the wires now. The CBOE global markets, their trading floor, they're not going to reopen until June 15th. And we know, of course, the New York Stock Exchange floor reopened just about a week ago after being closed for about 2 months, but of course at a much more reduced rate. There are many fewer traders on the floor. Michael, we're seeing a lot of investors flock to some of the hardest hit areas. I'm talking about materials, energy, industrials, sort of those cyclical sectors. Should investors be a little bit more defensive here with their portfolios?
No, look, I think as the Fed comes in and they start buying treasury bonds, and then they start that frees up balance sheets for the banks, because those treasury bonds need to sit somewhere. They either sit with the dealer or they're going to sit with the Fed. Now that they're sitting with the Fed, it allows these large commercial money center banks to be able to have capital for corporations for their money lines, as well as to buy risk assets. Okay. And then what you see from there is a cascading effect to all other risk assets. And now as that moves into risk assets, you start to, that cyclical trade that you're going to get in basics, industrials, energy, these things that happen at the beginning of the turnaround are start to kind of come in favor. And as Jared was just talking about, some of the emerging markets are going to start to come into favor too. So what you're seeing right now is the bottom of a business cycle happening in ultra fast time. So I like to think about the business cycle like a clock. So if 12 o'clock was the middle of February. 6 o'clock was the middle of March. And so you can move around that clock very quickly, but at different points on that clock, the same things happen. So that cyclical trade, the emerging market trade, all these things are starting to come into favor now. I will always own a portion of my portfolio in 30-year treasuries in case something does happen, in case there's some sort of war, these protests go off the rails, or the president does this or that. So you're always going to own protection in the form of a 30-year treasury, especially while the Fed's buying bonds. But I think the cyclical trade makes a ton of sense right now. And I look, if this is anything like the last one, we're off the races for the next 5 to 10 years. There'll be some hiccups along the way, but this is the way markets work.
Michael, the civil unrest we're seeing in the country, don't you think that's also an economic event? And if it is, why isn't the market pricing it in?
So, you know, I'd say it's a good economic event. It's bad for those whose stores are getting smashed and the property who's getting destroyed. But the flip side of that, it's showing us that we can open up and that these lockdowns have gone on for too far and too long. And 15 days to slow the spread is not hide under your mattress for a year until we find a cure. So the economy is going to start opening up very quickly. In the midst of this, one of the most restrictive states, Michigan, pulled back their emergency declaration, and they're starting to open up that state dramatically over the next few weeks. I think it'd be smart for a lot of governors to just reverse course now and say, look, we've done our job. We've protected as many people as we can, but we need to get back to a normal way of life. I think that's coming sooner rather than later. And so I think, you know, while it would be terrible if you own a store or you own a shop that was defaced, but I say the flip side of that is we can open up. This country can get back to work. And as we get back to work, you know, there's fiscal stimulus that has worked. There's monetary stimulus that's working, and we're ready to go.
All right, we're ready to go, Michael. Michael Lee, Michael Lee Strategy. Thanks for being with us.
Thanks so much, guys.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.